Hi, and welcome to the Macro Show. We talk macro and trying to make sense of markets that completely don't make any sense. I mean, people bidding up equities at close, bonds selling off. I mean, who does that, right? I'm your host, Steven Van Metre, and thanks for joining me today. Because today we're going to talk about how gold miners are indicating there's a potential major sell-off in the equity markets coming. We're going to do a little history lesson, go back in time, and really look at how the bond market, the gold mining stocks, and the broad equity market all have a close relationship and what happens when gold mining stocks unwind, because they're getting close to it. They're a big proxy of liquidity. We're going to take a look at the liquidity trap. I want to look more into that because a lot of people are like, man, you've got to be totally wrong. I mean, you're the wrongest wrong of all the wrong people that have ever been around, and you're wrong. But when you understand the liquidity trap and how all of that functions, you know that yeah, I could be wrong for a while, but then I'm going to be right. And so what a lot of people are seeing right now is fire and ash and the kingdom burning down, right? The kingdom under siege. It's horrible. It's the worst. It's good. This is it. It's over. We're finally going to get super duper inflation at levels never seen before in history of all mankind. It's just going to be ridiculous inflation. And yet, from all of these flames and all these flashes, you know what I see built coming out of these ashes? The birth of the greatest bond kingdom in the history of all bond kings. See, it's going to rise from the ashes just like it did before. And I'm going to show you how that happened. We've got charts. We've got stuff to look at, credit data. Why do we look at the credit data every week? What's so important about that? Maybe I haven't shared that with you, but we're going to get into even more specifically with this liquidity trap why credit's important. But if you tuned in to find out about the gold thing, let's just do that right now. Let's get out of the gate early on this. So here is TLT, the largest 20-plus Treasury maturity ETF. This is the most widely traded one. This is one I look at every day. And here you see the biggest bond selling event in history from here to here. This is the biggest selling event in the history. There are more people short, more people selling, more people dumping bonds than ever before. And yet it's only gone that far. You see normal bond selling events go like this, way down, straight down. And here you see straight down with a bounce. You get this little sideways, not much, but pretty much down. You notice how it doesn't really look like there's a lot of chop in this. So you think it's like, it's got to be coming to end soon. But let's go back to 2008, because this right here, my friends, was the birth of a great bond kingdom. You can see it right here. It is rising out of the ashes. And then, of course, people sold it off. But still, there it is, rising out of the ashes. Now, what does that have to do with gold mining stocks? Because they are a proxy of liquidity. So let's overlay the largest gold mining ETF, GDX. And there it is. So we can see GDX in purple and TLT in the green and red. So what is interesting about GDX here is you can see going back in 2007, it was forming a head and shoulders top pattern. Here's the left shoulder, here's the head, here's the right shoulder, neckline somewhere right around in here, and boom, obliteration. Now, why does that matter today? Well, because it's forming a head and shoulders top pattern. Let's just go look real quick. And we'll zoom into the 1-year chart, and you can see here's the left shoulder, head, right shoulder. There's a mini head and shoulders pattern here. Here's another one, left shoulder, head, right shoulder. Breaks the neckline. There's a neckline here at 33, another one at 31. Okay, so now that we've established that we're seeing a similar pattern, let's go back to 2008 when the birth of a great bond kingdom and castle came out of nowhere. And what was happening with TLT? It was selling off, right? Look at this. It had rallied off of a low. It had made maybe a triple top, something going on here. And look, it was selling off of this chop, this downward chop. It wasn't one of those straight down. It was this choppy down move. And you can guess what people were thinking in mid-2008, that inflation was coming, right? Inflation was here, and the bond market is showing it. It's going to collapse. It's going to go all the way back down to the lows and probably even further. And then something strange happened. GDX broke out of that top and came down. And what started to happen? Bonds started to reverse. This is a key thing to see here is bonds started to reverse, and they dipped a little bit, and then they started to go up, chop around, and take off as GDX collapsed. And if you can see, where bonds peaked roughly is not too far off where gold miners bottom. Now, isn't that interesting? So you can see we're seeing a very similar setup here where bonds are selling off, everyone thinks inflation is coming, and gold miners are topping. Now, how does that perhaps play into the S&P 500? Well, normally we'll go to the largest S&P 500 ETF, SPY. Where are we at? Here, 2008. Here's that head and shoulders top. Now, normally at this point, equity prices are falling. But look what happened right here when GDX puked. There goes the broad equity market. Boom. With it, bottoms, what looks like not quite 6 months later. So you can see GDX is telling us a lot. And the fact that GDX is in this topping pattern, well, let's remove the purple and go back and look at it. It tells you that something is wrong in the market. Here, this is beautiful pattern. Can't see it? How about we zoom out? You can see a little more clearly. Here's the left shoulder. Here's the head. Here's the right shoulder and separate head and shoulder pattern, telling us when it breaks 31, it's next 33, its next destination is 31, and from there, who knows where. But it brings everything with it. So the fact that everyone is now looking at the bond market saying, well, it's totally dead. This is it, game over. The fact that it's not a straight down shot and that we're back where the Fed is bought, and how odd would it be if maybe on Monday, before markets open, Powell comes out and says they're going to increase their long bond purchases. Who knows? But this is not typical of a massive sell-off in the bond market. It doesn't chop like this. Now, the other advantage here that did not exist back in 2008 is there isn't a massive amount of quant money sitting there in a neutral position. Now, the bond market had to work its way up and then take off. As of right now, you get back up into here around 156, 157 on TLT, and you're going to find those quants back buying in. And they don't buy in on a chop, they buy in and go up. So at some point, you'll see a reversal here as you see GDX continue to break down out of this top. And I know somebody's saying, but it looks very similar. That's because they are very similar. If we overlay them, as we've done before, you can see that they follow each other. So we know the GDX is likely headed lower. Here's GDX, there's TLT. You can see they're very similar. So we know GDX is headed lower. The question we get is, does TLT flip? Now, the answer to that question, well, is pretty simple. The probabilities of that are extremely high because we're stuck in a liquidity trap. Now, I want to get into that in a little bit, but let's take a look. There's not a lot of economic data this week, so let's take, or well, at least not since Wednesday. So let's get right into the unemployment claims. Now, a lot of people think unemployment claims are inflationary. Hey, lots of people are on unemployment. That means they have plenty of time to spend. Clearly, anyone who thinks that has never been unemployed. Here we see initial claims almost 793,000. 4-week moving average is 823. 20.4 million Americans receiving some form of unemployment benefit, and that is deemed inflationary because they have less income. Now, if you can figure out how people having less income leads to higher prices, I'd like to know, but it doesn't normally work that way. So unemployment claims continue to be a problem, continue to suggest that something structural beyond the pandemic is going on here, and the recovery will be slow and arduous. How about the 4-week and 8-week bill auctions? Look at that, 0.03, 0.035, right at the same level as last time. Nothing there, but the 30-year bond auction, right? This is where some bad things started to appear. But was it really that bad? Well, here's the tape on the auction. So the bid to cover, which is how many offers against, or how many bids against the offer, was 2.18. Now this is low. It's been around 2.3, 2.35. This is low. Here you can see the prior month at 2.47. So what really changed here? Well, the primary dealers bid a little bit more than they did last month. Direct bidders bid a little bit more than they did last month. And indirect bidders bid a little bit less. And you can see that they bid about $4 billion less. And the total was $59 billion versus $58. So there wasn't a huge change in bids. The difference was the offer was a lot more. We went from, what was this offer at $24 billion to $27. And because we didn't get a few extra billion, the bid to cover was low. The second thing that happened is the low yield, as we've seen in the past, has been zero. And this time it was higher. Now why would that be? Well, you got to understand, why do banks really need treasuries right now, specifically the 30-year? Because the Fed's buying $10.5 billion per month. So all these bonds that the dealers are taking at auction are maybe not these specific ones, but in theory, they're getting flipped to the Fed. So that means there's still a shortfall. The dealers have to go out and source to the market. All right, well, what happened in the market last month in the bond market? Well, let's go back to TLT. Let's look at the 30-day picture. Oh, looks like there's a lot of people selling. So maybe the dealers already had what they needed, so they didn't need to put in a low bid. Because if you go back 6 months and before all this selling and through here over the last month, you notice there wasn't a lot of selling. I mean, it was up and down moves. And so the dealers were bidding on the securities because they needed them. So my view on this auction is, well, the dealers just didn't need to make sure they had the inventory from the auction, so they didn't put in these major low bids. And as a result, we see some sell-off in the bond market. Back to the economic data. So is that auction terrible? No, it's not that bad at all. I mean, some people think it was horrible, but it's not all that bad. Let's look at the U.S. data here. Not a lot to say. We got the University of Michigan consumer confidence. Now, this is interesting in the sense that you have consumer sentiment. And so consumer sentiment has ticked down. Now, what's notable about this, and I'm going to zoom out just a little bit here. What does this look like? Treasury yields collapse, Treasury yields rising, consumer sentiment falling. Now, usually consumer sentiment tells you where not only interest rates are going, which are lower, but it also tells you where stock prices are going. Stock prices usually follow consumer sentiment. They're not right now, but you can see that consumer sentiment is weakening as consumers are losing confidence. Now, they are pretty comfortable where they're at now. Current conditions, no major change. Future conditions or expectations are dropping. There's your problem. You've got inflation expectations over a 5-year unchanged. Current inflation expectations are up pretty high at 3.3. That perhaps is getting the bond market a little excited, but that doesn't really change. Consumers don't really understand what inflation is. Now let's talk about the Fed, because on Thursday the Fed came out and usually they update their schedule for every 2 weeks, and now they put out a whole month schedule, and guess what? Their purchases were unchanged as usual. So what again is driving this big sell-off in the bond market? It continues to be speculative selling, overnight trading. Look at the overnight here, right? Here was last night, somewhere around 1 a.m. Boom, selling. What was driving that? Don't know. But you'll notice the volume is real light. It's easy to move the markets in overnight trading, particularly if you're a computer algorithm that knows how to do that. You start selling and easily move the market down. And of course, you can easily move it up. So where are we? Well, as I mentioned before, we're right back where the Fed did their big QE purchase back in the midst of the COVID crisis. So you see that. Anyways, let's get on to what I'm really interested in is this liquidity trap. So here is the M2 money supply. Now, why we want to look at this is up here in January. Let's see, why are we're not all the way over? We got a little bump from the stimulus package mid-January, and look what's happened. It's flatlined. Absolutely, it's decreased a little bit. So there's not a lot of growth in the money supply. Now, remember, when we talk about liquidity trap, what is it? It's when the demand for money is growing faster than the supply of money. So how do you get inflation? Well, the supply of money needs to grow faster than demand. How do you get no change in inflation? They're both growing at the same rate. And how do you get disinflation or deflation? Demand for money is growing faster. Now, what's the easiest way to look at that? Well, the answer to that is the monetary base, and that is growing. And why is that growing? Well, it's due to the Fed, of course. We know the Fed is going to continue doing QE, but yet the money supply is not growing here. And when we look at the H.8, there's a factor here that's important to understand. How does money get into the M2? People borrow it. Money's created. Did you ever think about that? Money's created, it gets borrowed, gets put in, it gets into the M2. Checking, savings, that's how it gets there. So if you see a strong move in lending growth, that's going to drive the M2. And if you see lending growth decelerating or even worse, contracting, what do you think that's going to do to the M2? Well, it's going to put downward pressure on the M2. And so that's what makes this really interesting is we can already somewhat predict what's going to happen. Because a lot of people are worked up over, there's going to be all this inflation from the next stimulus bill. Well, look at what we just see right here. We saw a move up and then nothing. Maybe it's because of the H.8. So let's look at this because we have that new monetary base data now for the month of January. And here's a money multiplier. Easiest way to look at this. And what do you see? The demand for money is growing faster than the money supply, hence the downward move here. That's what this is. Now there's a slight uptick, but this will change because that slight uptick in the data is right here. Is this move higher after the last checks went out, and now it's flatlining. So we know next time, assuming there's no change in the money supply, that the money multiplier is going to head lower, and this is your liquidity trap. Now, when you look at this compared to the consumer price index, it gets kind of interesting because you can see that when you see generally when you see a rise in the money multiplier, you see consumer prices rise. But we're coming out of the 1980s when they started lowering rates, and it starts to normalize out here in the 90s. And what do you see? The demand for money is rising faster than the money supply, and it puts downward pressure on inflation and red. See it? They go down. And then they start to go flat together. Now, what does that mean? Well, it means the demand for money and the supply of money are growing at a similar rate. You can see that here in the blue. Now, why is that not causing inflation? Well, because how do you get inflation, right? You need lending growth. And what's the easiest way to see lending growth? When you see interest rates start to go up. But what was really happening there, we'll look on the next slide in a minute, it was going down. So why would interest rates need to go down? To spur credit creation, to create money to go in the M2 to get inflation. Well, it finally does. And the the money multiplier starts to rise. The M2 is rising faster in demand for money. Consumer prices rise, and bam, you get the great financial crisis. Now the demand for money is skyrocketing faster than the M2 because CPI goes negative. And now we get some interesting dislocations here. So there's some early kind of workout of the CPI coming out of negative territory. And then look what happens here. You can see back in late 2010, 2011, inflation is rising, right? Here we go. Inflation's coming. This is it. And yet look at the money multiplier. It's falling. And who reigns supreme? The money multiplier does. And the next thing you know, inflation's coming down. The money multiplier is rising a little bit, but look how fast inflation comes back down. Then once again, inflation's chopping, starting to rise. The money multiplier is falling, and all of a sudden, boom, inflation crashes down to the money multiplier. And then they're rising together. The CPI gets a little bit fast and then crash. And then it gets a little bit quick and crash. It's a little bit too fast and crash. And here we are again. Look at that same gap. See, we already know how this plays out because we're stuck in a liquidity trap. And what that means is when the demand for money is rising faster than the money supply, that gap has to be filled by one thing only: lower prices. Prices must fall to fill that gap. So when you hear all these people talking about there's going to be all this rampant inflation, prices are going to rise, it doesn't actually work that way in the real world. Now, doesn't mean businesses can't raise prices. That can absolutely happen. They will, and they will. But what happens to the consumer is they don't have the money to absorb those prices. So think of it like right now, energy prices are rising. Food prices are relatively high. And that means it's taking up more of the discretionary spending that a consumer has because they need to buy those things. Plus, they've got a bunch of debt, leaving them with less money to spend elsewhere. So if they have less money, those other businesses that are raising prices say, hey, everyone else is, I'm in on this deal, consumers can afford it. What happens is the demand for their services goes down. And if you own a business, what happens when demand starts to fall? What do? You cut prices. You don't raise it. Like, man, my restaurant's empty. I guess I'll just raise prices. It must be too low. People don't think there's value here. No, they lower them. What do you think happens with interest rates? Why do interest rates fall? Because people can't afford the loans. So the demand falls and interest rates fall. Let's take a look at that. And this is, again, another reason why I'm going to end up being right is because look here, when the money multiplier was flat and the consumer price index was flat. And what had to happen to keep that up, to keep the money supply up with the monetary base? Interest rates had to fall to create enough money just to keep things equal. And then all of a sudden the money multiplier rises. There's definitely money being created. The money supply is rising. Interest rates are flattening out. They both crash. But look at this. Every time you see in red, interest rates rising, money multiplier falling, rates fall. Rates are rising, money multipliers rising slower, rates fall. Now they're rising together, rates break, head lower, money multiplier crashes down. And even in here, you see this little rise in rates gets rejected. And now we're supposed to believe that we're going to see a secular rise in interest rates at a time when the demand for money is rising more than the supply of money. So that means people will have less money to go out and finance and buy things, so they won't buy them. And that's how you know that interest rates are more likely to head down than up. In fact, the probabilities are so high because the liquidity trap is a real thing that you know this is going to happen. All right, let's take a look at a few, boy, we got a lot of charts going on here. How about the H.8? What do we have going on here? Bank credit up 1 billion. Securities and bank credit up 18 billion. Mortgage-backed securities up 18 billion. U.S. Treasuries down a mere 6. Loans and leases. So here, looking at credit growth, down 18 billion. Commercial industrial loans up 5 billion, which is nothing given how much it's fallen. Residential real estate down 5 billion. People are paying down their mortgages faster than new ones are coming in. Commercial real estate finally actually had a down month, a week down 12 billion. Consumers, which people have been talking about, are spending more. Credit down 2 billion. Cash assets at bank down 62 billion, which is staggering. Let's take a look at what's going on over here. Money supply, we already talked about how it's flatlined. Look at real estate loan growth. Growth rate is down to 0.51% from a year ago. Both the 6-month and 3-month are negative, meaning money is being destroyed on a 3- and 6-month basis and is about to be destroyed on a 12-month basis. That's not going to help the money supply. Now, commercial industrial loans is hot, but this isn't hot because there's a lot of lending going on. It's because of that big prior spike. But look at the 6-month rate of change, minus 9.3. 3-month rate of change, almost minus 4. Money destruction over a 3- and 6-month rate. How about total loans and leases? Now, everything, all included, consumer, everybody. Growth rate is this actually should be down to 2.77% from a year ago. 6-month rate of change is at minus 2.35. 3-month rate of change is minus 1. So on net, you have money destruction from credit contraction. And here, credit cards, people are talking about, oh, there's a lot of spending going on, down 13.3%. So maybe consumers are charging, but they're also paying their balances off and then some. Here's some charts to look at as we wrap up the show. Weekly leading index. This is the ECRI. It's showing the second highest value in history. Now, what does that tell you? Is that the beginning of something or a peak of something? Remember, this is a diffusion index, most likely signifying that we are at a near-term peak in this run up in this cycle. How about trading frenzy? We have equity volume approaching peak not seen since the pandemic crash. Well, that's interesting. The VIX index follows trading volume. Well, that would be cool because guess what also follows that? Bond prices. How about U.S. call option? People are speculative betting on this market like none other before. U.S. call option trading volumes have gone parabolic. That's pushing equity prices higher as people are just betting like crazy. How about, you want to know the other thing driving stocks? Largest week of global equity inflows ever. Wow. So people are all in on the U.S. market. Crazy. How about University of Michigan buying conditions for vehicles? This almost at a second lowest level since looks like 2001. Maybe going to be a good time to buy a car in a couple months. How about household income expectations? People are talking about inflation, and I'm talking about liquidity trap. Well, here you can see a liquidity trap. Their income expectations over the next 1 to 2 years are lower. So how are the people going to afford higher prices? Well, my friends, the answer is they are not. Now, I don't know when the bond market is going to flip and reverse, but I know at some point it does. It sets up a phenomenal 6 to 8 year run if you know how to play this right. Thanks for being fans. I'll see you on Monday. Or Sunday for the chart show. I'll still do that even though it's a holiday on Monday. I was going to do a macro thesis update on Monday, but I think I'm going to do something on reserve assets and how that ties up the dollar and things like that. I want to go a little deeper and showing you why what we're seeing here in this liquidity trap leads to a higher dollar and ultimately higher bond prices. I'm Steven Van Metre. Thanks for watching. I will see you soon. The content of this video provides educational information only. Is not intended to provide investment or other advice. Serials not to be construed as a recognition or solicitation by Social Security and finance for instrument or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.